Daily Fiscal Pulse for the 16th of June, 2026. We're working with Tuesday's settled data here, not real-time figures. Let's start with what's happening in the broader environment before we dig into the numbers. The Iran and Middle East conflict is dominating headlines right now. You're also seeing significant coverage around Kevin Warsh's first meeting as Fed chairman, and that narrative is clearly moving markets. Of course, headlines only tell part of the story. The flows give us the real picture. The net fiscal transfer for the session came in at $23.4 billion, which on the surface looks reasonable. What's more telling is the underlying shift. The 5-day flow has compressed to roughly half of recent levels. Tax receipts are leading the charge at $35.1 billion. The S&P 500 futures tell a somewhat different narrative. ES closed at 7,519, maintaining support above the 20-day moving average, which sits at 7,502. The 20-day range is spanning roughly 385 points. Equities are holding steady despite the fiscal headwind we're seeing. Step back and look at the bigger picture, and the dynamics become obvious. Government spending on a 5-day basis is averaging about $22.7 billion per day. That stacks up against a 20-day average closer to $4.4 billion. The slowdown is significant. You're looking at less money flowing through the system, fewer dollars making their way to households and ultimately into markets. That tightens financial conditions. Pull back even further and year-over-year comparisons reinforce the theme. Spending on a fiscal year-to-date basis stands at $999.3 billion, roughly 8% lower than the comparable period a year ago. That's a substantial reduction in fiscal stimulus, and it affects system-wide liquidity. For those on the bullish side, the fiscal backdrop isn't working in your favor right now. Our conditions gauge is reading -61, but context is everything. We've navigated similar scenarios repeatedly, and even with weaker liquidity, the S&P has posted an average gain of about 1.6% 1 month forward. Liquidity and market performance don't move in lockstep. Equities routinely grind higher regardless. One thing worth flagging on positioning: margin debt is sitting at the 100th percentile, which signals elevated leverage. Historically, when leverage reaches that threshold, it functions more as a caution than a bullish signal. Let's connect the dots. With fiscal flows trailing year-ago levels, the shock absorber in the system is thinner. When news breaks favorably, equities can keep climbing higher, but if a risk event materializes, say an escalation in the Iran and Middle East situation, declines can accelerate because there's less liquidity underneath to catch the fall. There's a calendar to keep an eye on going ahead. The 17th of June brings the SSA payment cycle, which falls on the third Wednesday, and that timing can influence short-term flow dynamics. Fiscal drag is showing up clearly in the data. That said, the pace of tightening may be finding its footing. What happens next really hinges on how these scheduled flows materialize. That's where our focus is.